क्या आपने कभी सोचा है कि आपकी इन्वेस्टमेंट पोर्टफोलियो की ग्रोथ अगर ऑटो पायलट में हो तो कितना सही होगा? साउंड्स एक्साइटिंग, राइट? हम सबको इन्वेस्टिंग करते वक्त कितनी सारी चीजों का ध्यान रखना पड़ता है। डेली रिसर्च, चार्ट्स, मार्केट न्यूज, ट्रेंड्स एंड यस, ये सब के साथ स्ट्रेस तो फ्री में मिलता है। But what if there was a way to cut down all this and almost put investing on an effortless growth mode? This is possible by a method called passive investing. In this masterclass, we are going to decode exactly what passive investing is, how it works, and why it's growing so quickly in India. So let's start from the basics. Passive investing is basically like putting your investments on autopilot. Now, instead of trying to beat the market, timing rallies, or constantly picking stocks that might outperform, passive funds simply copy the index. If the Nifty 50 goes up, your fund goes up. If the index dips, you follow that dip. It is simple. No surprises, no drama, and no chasing the market. Now the question is, ये concept आया क्यों? Well, the first reason is performance. Globally, for many years, one trend became very clear that even though active fund managers try extremely hard to outperform the market, consistently beating an index over long duration is very difficult. Maybe they outperform for 1 or 2 years, but 5, 10 or 15 years, not so easy. And this led investors to ask, if the index itself grow over time and most active funds struggle to beat it, then why not just track the index directly? Well, the second reason is cost. Active funds require analysts, research, and more trading. Naturally, they are more expensive. Passive funds simply mirror the index with lower effort, lower trading, lower cost. The third reason is simplicity. Passive investing gives you a clean, transparent, predictable way to participate in market growth. Now, coming to how passive funds work. It's quite simple. Passive funds create a portfolio that contains the exact same stocks in the exact same proportion as the index they are tracking. Now, if the index has 10% in a stock, the passive funds aim for 10%. If the index adds or removes a company, the fund mirrors that change, which is called rebalancing. Now, because passive funds hardly trade, the expense ratio stays low and investors get more of their money working for them. In short, passive investing exists because it removes complexity, reduces cost, and mirrors the market in a disciplined, rule-based way without any need for day-to-day decision making. Now that we have understood what passive investing actually is, let's move to the next segment. Why is passive investing suddenly becoming such a big deal in India? Because honestly, 10 years ago, passive investing was barely a conversation. India was a full-on active market where fund managers were seen as experts who could spot opportunities, beat the market, and deliver. But today, things are changing and changing fast. One major reason is accessibility. Earlier, passive funds such as index funds and ETFs were limited, confusing, and not very popular. But over the last few years, investor awareness improved, fund options increased, and SIP culture genuinely took off. Second, cost consciousness. A lot of investors realize कि अगर उनका long-term goal wealth creation है, तो low-cost options actually help accelerate growth. And passive funds have some of the lowest expense ratios in the market. Third, data transparency. Investors today are more informed. They compare returns, check performance, and track consistency. And सबसे बड़ा point, global trend. The US, Europe, Japan all saw massive shifts from active to passive investing over the last 2 decades. And India is now entering the same cycle. Since March 2023, the AUM has grown 1.7 times, which suggests investors are increasingly preferring passive routes over active ones. So yes, passive investing is growing and it's growing for strong structural reasons. Now, let's get a bit deeper into the passive universe because it's not just one type of fund. There are actually multiple passive options, such as number 1, index funds. These simply replicate an index like Nifty 50, Sensex, Nifty Next 50, etc. No active decision making is involved, just pure replication. Number 2, ETFs. Exchange traded funds work like index funds, but trade on the stock exchange. Here, investors can buy, sell them like shares. Number 3, beta funds. These are slightly advanced. They don't just copy the index, but they follow rule-based strategies like low volatility, quality momentum, but still avoid active forecasting. Number 4, international index funds. These track global indices like S&P 500 or Nasdaq 100 giving Indian investors international exposure through a passive approach. In short, the passive universe is much wider than it used to be, and investors now have options for every risk profile and time horizon. Now that you know the types, let's talk about limitations. They give zero flexibility as funds cannot avoid falling sectors. There's no chance of outperforming since it only tracks. The deep corrections impact passive investors fully since the fund follows the market exactly. तो ओवरऑल पैसिव फंड्स एक ऐसे इन्वेस्टर के लिए परफेक्ट है जो लॉन्ग टर्म वेल्थ बनाना चाहते हैं बिना डेली मार्केट मॉनिटरिंग के. If you prefer simplicity, discipline and low cost, passive investing can be a solid foundation for your portfolio. That's all in this masterclass. Also do let us know in the comments if passive investing will dominate India's mutual fund space in the next 10 years. And don't forget to like, share and subscribe for more insights. See you in the next one.
Investments in the securities market are subject to market risk. Read all related documents carefully before investing.